Welcome to the Future Impact Skills Profile. Today we have Shali Lingaretnam from Victorian Funds Management Corporation, the Head of Investor Stewardship, and we're talking about ESG investing. So Shali, can we start with just a bit of an introduction of why is ESG, what is it and why is it important to the investment decision-making process?
Great, thanks Yolanda. And it's clearly an area and topic that I'm terribly passionate about. But I guess before I sort of launch into why I think ESG investing is important, it's also important to talk about my background. So I've actually come over from the investment side to now operating in an ESG capacity on a full-time basis. And so a lot of, I guess, the relevance of how ESG has come from actually being an investor. And so I think if we look back through history, governance, which is the G of ESG, has always been at the bedrock of any investment. And you'll find that in every aspect of all of the, I guess, fundamental valuations that you would have in any of the asset classes. So whether it's a property investment, equity investment, debt investment, governance is really at the heart of that. What has really evolved over time is how the market has really incorporated and understood the implications of both S and E factors on investments. So as we've, facing our existential crisis of climate change, the E, or the environmental side of ESG, is really prevalent in every single asset class that we look at. We see that coming through in the broader market appetite. Personally, we look at how we incorporate climate into our capital market assumptions. So really, if you think about it from the bare bones, that's where you sort of incorporate ESG fundamentally. So it's core of what we do, and it's core of investing, which is why it's incredibly important to take that lens.
Yeah, great. So let's now think about it from the practicality sense of how do you actually incorporate those ESG considerations into an investment analysis?
Yeah, great question. So what I might do is I might walk through maybe a typical sort of equity type investment and go through each of those, the E, S and G. So if we start with E, when we think about modelling out cash flows, some of the things that you might want to consider is factoring in a carbon price or a carbon tax for a high emitting company in the way that you value the cash flows. So we know in Australia we have the safeguard mechanism, and we know that high emitting industries are captured by this safeguard mechanism, which then means that there is an implication from a carbon tax. So that's one sort of practical way in which you could incorporate the E into the financial valuation of a company. In terms of the S factor, this is where it's, there's a couple of different ways in which you could look at it, but one of the areas that we've seen really great and long-run research is the role of, say, human capital indicators to financial performance. And so what I mean by that is the prevalence of, absenteeism, turnover, to loss of productivity, and obviously loss of revenue. So we've seen that sort of causal relationship exist in markets for some time. And so that's another area where by analysing trends in sort of human capital indicators, you can start to make some assumptions of what you think that might be occurring within a business in terms of its productivity. And then if we look at governance, so governance is, as I said, it's the bedrock. It really starts with boards and management and really looking at how they're aligned to the strategic vision of the organisation, how they're actually allocating capital to that, and whether it has the discipline, so that is a governance element, and really how effective their modelling of that corporate behaviour has rolled out across the organisation. And this really ties into this a much more broader concept that is a bit newer in the market, which is this concept of social licence. So really ensuring that these companies have got the social buy-in by society to continue in its current form into the future.
Yeah, fantastic. So great examples of the things to consider. Now let's get into, as a final question, modelling. How do you actually bring this into a financial model which guides so many investment decisions? And maybe let's think of it as a risk and an opportunity side.
Yeah, absolutely. So I think when I might just start with opportunities because I am a bit glass half full. So if we look at it from an opportunity perspective, let's take environment, for example. If you've got an organisation that it has previously had, a line of business that might have been high emitting, so let's take a gas company, for example. And what we find is that part of their business is to now sort of de-risk, so maybe reducing the reliance on that gas income by doing acquisitions into other businesses that might be value accretive, but would be what we consider green tech or green technology, that would be having a much greater growth profile in future. That would be an example where we would model that opportunity and the future cash flows that would be generated from the demand that would be created off the back of that. So that would be one such example. In terms of the risk, it would also be the inverse of that. So there's this concept of stranded asset risk. So if it is a gas pipeline or a gas asset, what we need to do is think about what is the long-term useful life of that asset and the demand profile for it, and whether there is some stranded asset risk. And so that really comes back to your long-run cash flow expectations for that asset, which then is, that's where you possibly be adjusting your DCF to account for that. Or if you're working in an industry where you've got a couple of companies that have got different approaches to how they're managing those gas assets, then you might make a relative value adjustment to that valuation.
Great. So it sounds like it's like any other investment decision-making process. You're modelling cash flows, building in assumptions that are incorporating ESG principles to ultimately determine current and future value, to be able to inform, ultimately where capital gets allocated, which is such a powerful part of the investment management system.
Correct, that's right. Yes.
Yeah, excellent. Well, thank you so much. That's a really great taster to set us up for those that want to do more research on how to incorporate ESG considerations into investment decision making, and of course explore the incredible career opportunities that exist for people that want to change the world through the capital allocation process. So thanks so much for your time today, Shali.
Fantastic. Thanks, Yolanda.
Thank you.